Hey, I'm very excited to talk about the PMI today, private mortgage insurance. And so, some of the things we're going to talk about, there is a borrower paid PMI and there's a lender paid PMI. There is a PMI for FHA also, and there's a PMI if you're doing a conventional loan. So, and in the end, I do want to mention about a good news if you stay together with me through the end. So, what is PMI? PMI is a private mortgage insurance. A lot of people, when they're buying a home, they cannot afford 20% down. So, if you are putting less than 20%, you will have a PMI. Now, PMI works different for FHA loans versus conventional loans. There is an upfront PMI with the FHA loans, and there's a monthly PMI. So, monthly PMI is 0.85 of the loan amount, and it remains on your loan because most of the time the FHA, you're putting 3.5% down, and it takes about 11 to 12 years, which is like $200 or $300 every month. So even though your home value probably goes up, you're still going to end up paying FHA. And about 11, 12 years, your principal goes down to 78%. And at that time, FHA, will get rid of the PMI. Even though your price value goes up, and then you call the lender and say, hey, my value goes up, can I reduce the PMI? No, you have to have your loan down to 78, 80%. So that takes about 11 years, to get your principal down. Conventional, probably the same way if you want to get rid of the PMI, 78%. But the PMI, the monthly PMI, that is the difference. It's not constant as the FHA, which is 0.85. It varies depending on your credit score, depending on your loan to value. So those are the things how they calculate the PMI. So I have a calculation, and in this scenario, we're talking about 85% loan to value. Someone put 15% down, or maybe we are doing a refi, but loan to value is 85%, credit score is 700, and loan amount 563. It is something you need to discuss which option is better with your loan officer. And your loan officer should give you a breakdown and discuss with you what's your short-term and long-term goals to decide to make a good decision for you, to help you to make a good decision. So this is an example, 563,000, you have 700 credit score. Yeah, if you have a borrower paid PMI, the rate is 4.5. Lender paid PMI, there is no PMI, there's no monthly payment, but the rate is higher. So 4.75 versus 4.5 here. So payment 2852, there is a monthly PMI 183, and if you add those together, it's 3035. With lender paid PMI, your payment is 2937. Now, if you look at the difference, it's $99 less here. Even though you have an interest rate lower, you're still paying $99 more. So my recommendation would be to go with this option, even you're paying $99 more. And my reasoning is the loan to value is 85%. So this is a pretty good low interest rate. And maybe in few years, if the 5%, maybe $25,000, if you're able to pay it down in a couple of maybe years, you're still going to have a low interest rate of 4.5, and then this PMI will go away. So once you pay it down to 78, 80%, this PMI is going away. Now you will have a 2852 for the remaining 28 years. Versus here, you're gonna have 2936 for rest of the time. Hope that explains. There's a lot of things with the PMI. And we're probably gonna do some more episode in near future. I would recommend to prescribe to the YouTube channel. I'll try my best to have once a week a new episode with respect to the mortgage, and my goal is to share this education for you to handle your the largest debt, which is the mortgage. Till then, have a great day.